Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And as I was looking at the YouTube attendees before this webcast launched, I noticed we have a big audience today. Hundreds of people watching a live stream, and most of whom look like they're first-timers here. So welcome to all of you first-timers, and I think that sets the stage for a discussion where I think we're going to just go right at the beginning. I want this to be a beginner's guide to trading covered calls for income. I think this is going to be an interesting discussion. We're going to be looking at this popular income strategy. We're going to be weighing the pros and the cons. We're going to be looking at example trade scenarios on the Thinkorswim desktop platform. And we're actually even going to be placing example trades today. A lot to cover. I'm looking forward to all of it. Before we get to any of that, though, let me first of all say hello to everybody who's chatting in out there. Hello to all you new people. Hello to the veterans. Great to see Phil and Brew, Duke of Foxborough, Coco, Kevin, John, Lawrence, Dwayne, Eva, Will, Kelly. On and on that list goes. Thanks for being here. I always do appreciate the attendance and the contributions of our veterans here. If you are a first timer, great to have you on board. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. It's a great way to watch these webcasts. But be aware that you're invited to join us in the live stream if you'd like to be here. This is a Monday webcast series, and we kick things off promptly at 2 Eastern time every Monday. I also want to let everybody know here in attendance in our live stream that my very good friend Barb Armstrong is going to be hanging out in the chats with us. Barb and I have been working together for years. So Barb brings a ton of experience to this discussion. Barb's going to be keeping an eye on the questions that come in through the chat. If I can't get to those, she's going to be there to pick up my slack. Thanks for having my back there, Barb. And Barb and I would like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite Schwab presenters there on X. You can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. If you reply to one of my posts, I try to reply right back to you and allows for nice interaction when the camera's not on. You can also follow me on LinkedIn. So just look for Cameron May. Look for the guy sitting in front of the castle. You know we found the right person, but let's get into this discussion. Of course, as we dive in, there are risks associated with what we're doing. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's lay out an agenda for what we're going to be discussing today. Since I see so many new names out there, hundreds of new attendees, I want to go to a pace that everyone can follow. So we're going to be talking about selling covered calls for income using a real-time example from the markets. But what I want to do as we're setting that discussion up, we're going to go look at an example covered call. We're going to talk about what a covered call is, the sort of the details of the contract that the trader is getting themselves into. We're going to weigh the pros and the cons of the strategy, and then we're even going to show how to push all the buttons to get an order entered if a trader has an interest in selling covered calls for income. All right, so let's go right to the Thinkorswim desktop software platform. Now, if you're not familiar with this platform, let me show you what we're looking at here today. So I'm going to be using some trading software that is available to download free of charge from within your Schwab Online account. So before I go using the software, let me show you how to download this. You just log into your online account on Schwab, go right up to the Trade tab, and then look for Thinkorswim Desktop in that drop-down menu under the Trade tab. If you click on that, all you have to do is scroll down just a little bit, and you'll see a big blue button. Can't miss it. Learn how to enable Thinkorswim. It'll walk you through the process of downloading the free software. It'll create an icon on your computer's desktop. It looks like this. It looks like a splash for Thinkorswim, splash. Anyway, but you can just click on that, log in using your Schwab credentials. There are no special credentials required for Thinkorswim to access the software. And you can get in and get started using the software that I'm using today. Now, I also want to point out that when you first log in, it's going to create a pop-up on your screen. It looks like this one right here. Down at the bottom of that pop-up, it's going to ask you for your login, your Schwab credentials, your username and your password. Down at the bottom, though, it'll ask you, hey, Cameron, are you doing some live trading today with your real balances, or do you want to do some practice trading using what's called paper money? Either one of those can be accessed using your Schwab credentials. I'm going to be using paper money today. It's a practice platform where we can see almost all of the tools that are available on the software and play with those without having any real skin in the game. Yeah, so you might want to if you're following along at home, try paper money first with new strategies. All right, so let's go to our paper money account, and I want to talk about selling covered calls for income. Now, if we look at a stock like Broadcom, and Broadcom is a stock that we have in the example portfolio for this webcast series. We purchased it just, well, some time ago. Let's see, I believe it was trading down here in the 220 range. So the stock has done pretty well since then. So if we go to our monitor tab here, we can see that position. There's our Broadcom position, 100 shares of stock. And when we own shares of stock that are publicly traded, if they are optionable, the trader might be able to enter into a contract where they agree to potentially sell those shares to someone else. So kind of an interesting concept, this concept of trading covered calls. It is a contract between two traders where one agrees to maybe sell shares to another one. In exchange, they're being paid to get into that. So we'll talk about exactly what that is, but let's look at the chart of Broadcom. And as we do that, I do want to talk about what kinds of stocks, since we're using Broadcom as today's example, what may pre-qualify a stock as a potential covered call candidate. There can be a whole range of reasons, but let me just summarize it this way. Covered calls are an income strategy for stocks that hopefully the trader doesn't mind owning for a while, because we have to own the shares in order to have the covered call position. So the motivations for owning the shares are probably very similar to the motivations for owning shares in any case. It might be that the investor thinks that this company is really strong in a particularly good sector. Maybe they like the way the company fundamentally operates, the product it offers, the advantage it has over its competitors, whatever, those sorts of fundamental qualifiers. However, when trading options, there are some other things that may come into play as well. Now, I shouldn't say other, they might already be a consideration, but obviously price per share. Yeah. When selling covered calls, we enter into contracts in almost all scenarios to potentially exchange lots, round numbers of 100 shares or multiples thereof of stock, right? So 100 shares of Broadcom in this case, or 200 shares or 300 shares. Options are traded in what we call these round lots. So if we're buying 100 shares as a minimum, well, 100 shares of a $364 stock is a $36,400 trade. If a trader can afford a $364 stock, price enters into the equation. Maybe they look at a lower price stock, maybe a $100 stock, maybe a $50 stock. So that can be a consideration. But additionally, liquidity can be a particularly high priority for options traders, because illiquid stocks tend to have illiquid options contracts, and that can really dramatically affect the pricing of the options and make them pretty hard to trade profitably. Options already carry risk. If they're illiquid, that can just compound the risk of trading options. So yes, there might be some sector considerations, there might be fundamental considerations, there might be liquidity and price considerations, but also for some traders, they look at what's happening with the stock chart. So look what's happening with our Broadcom shares. Put yourselves in the shoes of a trader who maybe purchased back here when the shares were close to 220, and the stocks had a nice run up, getting some nice capital appreciation in our investment. However, most recently, we've hit a peak just about, a little bit below $390 per share, and the stock has been pulling back. So traders recognize that no stock tends to go straight up. And maybe they can for a period, but stocks tend to instead go through cycles. They run up and they pull back, and they run up and they pull back. Well, during that pullback period, if appreciation isn't delivering returns to the investor, maybe at that point, a trader might turn to something like an income strategy, such as selling a covered call. So I'm going to propose that as just the example scenario for today. All right. Let's say that our investor purchased their shares. They've seen them run up nicely. They think that we're kind of bumping our heads against a price ceiling and starting to peel back. And let's say that we just expect that to continue for a while. Let me draw in a line here. We have drawing tools right down here in the lower right-hand corner of Thinkorswim charts. And I'm just going to choose this one that allows me to draw a trend line. And let's just draw in a line around 390 bucks. Let's say that for a period of time, maybe, a couple of weeks, 3 weeks, something like that, maybe our trader thinks that the stock is going to remain below that price for a while. And so they think, well, let's consider maybe leaning into this strategy known as a covered call. Let's look for some income while price appreciation isn't really doing it for us. So let's go do a covered call. And I remember when I first started learning about options, it was kind of a nerve-wracking experience because we're dealing with contracts here. And anytime somebody waves a contract in my face, I get a little bit on edge. I want to make sure that I understand what I'm doing, know the pros and the cons before I sign on the dotted line, right? Yeah, this is a contract between two traders. Now, fortunately, this is a practice contract in a simulated trading environment. So we're not concerned that there's some real money at risk here. But what I want to do is go enter into a contract where we know that we own 100 shares of Broadcom in this account, and we're going to go enter into a contract where we're agreeing to potentially sell those shares to someone else. And in exchange, so that's what they get out of the deal. In exchange, they're going to pay us, as the hypothetical trader here, a certain price per share to motivate us to get into this contract. So I'm going to go to the trade tab. And if you haven't used Thinkorswim before, we just type in our symbol up here in the top left, make sure that we're looking at the correct stock. Just below now, we're seeing quote information for the stock price, but below that, we see what's called the option chain. And this is kind of like, I think this is I kind of think of this as like a bulletin board. It's an advertising bulletin board for the types of contracts a trader can get into. So let's see, I just saw a question come in. Who's this trying to sell us a bunch of stuff on this chat? Or, oh, there shouldn't be anybody selling stuff in the chat. No, that's right. Yeah, Barb will keep an eye on that. You are here to hear about covered calls from me, right? Yeah. Thanks for the little call out. Anyway, yep, if you're not familiar with an option chain, what we're seeing here are contracts. You'll notice they each carry dates. There are some that just run for a few days, 4 days in this case for some 7th of November contracts, all the way down to, we could get into some contracts for years, 809 days, taking us through the 21st of January of 2028. Let's say that our trader prefers not to put themselves on the hook for a terribly long time. And instead, how about if we look at these ones? Let's look at the 21st of November, 2025. These are 18-day contracts, and the 100 here just is a reminder that this is for the potential exchange of 100 shares of stock. These are what we call standard contracts. So there's a little caret icon here, little arrow. I'm going to click on that, and that exposes a bunch of different contracts with that 21st of November expiration that we might choose. So for today, I'm just going to quickly pick one. And then we'll go back and sort of talk over the motivations for which expiration to choose on a contract, which length of time frame we might choose on a contract, which strike price we might choose on a contract. But with the stock trading at 364, and with our traders' suspicions that the stock is likely to stay below 390 for a little while, well, let's say that we go to 390. If you look at this center column, it says strike. Just think of it this way. This is a price at which we might strike a deal with another trader out there to potentially exchange shares of stock. So I'm going to scroll down a little bit. Let's look at the 390 call strike. If we look in the left side, we're talking about call options today. We're going to be ignoring this right side, which is put options. That's a discussion for another webcast. But I'm going to look at this 390 call. And what I notice here is with a bid price and an ask price of 605 to 640, it looks like we might be able to collect somewhere around $6 per share, up to maybe as much as $6.40 per share to enter into a contract. Let me spell this out explicitly. All right. So today's example strategy, let's make this nice and bold. It's a little bit easier to see. Ample strategy, covered call. And we're considering, we know that we own 100 shares stock, and in this case, that's Broadcom. That's half of the strategy here. The other half is selling a call contract. In this case, we're considering selling the 21st of November 390 call, or somewhere between 605 and 640. Let's say that we can get $6.20 per share here. I'm going to go ahead and place that trade and execute it. And then I'm going to talk about what we just got ourselves into. All right. So let's go to that 390. I'm going to click on that bid price on Thinkorswim to sell an option contract. We just click on the bid price next to the strike that we're interested in. So I'm going to click on 605, and that creates an order here for actually 10 contracts. I'm going to change that to just one. Let's sell one Broadcom, 21st of November, 2025, 390 call. And let's see, you know what? Let's say that let's try to get at least 610 for it. You just type in our price here. We're going to put in a limit price, meaning that's the least that we would accept as a payment here. I'm going to make that order good for the day, and I'm going to click confirm and send. Selling that one call. And notice what I'm doing here. I didn't actually choose anything that says covered call. All I'm doing is selling call in the account where the Broadcom shares are already held. I don't have to designate it as it's, hey, this is going to be a covered call when we're done. Don't have to do anything special like that. Just make sure that I'm selling the call in the account where the shares are already held. So let's sell that, see if we can get $6.10. That would bring in $610 of potential premium here. There is a commission to be paid on this trade, 65 cents, not 65 cents per share or anything like that, just 65 cents. So that could chip into the net credit that we receive, but let's send that off. And let's see if we can get that order filled. So that order is out there waiting. If I go to my monitor tab, oh, it looks like we did sell it for 610. Okay. Let me open up my left sidebar again here. We just sold a call contract for $6.10. And I think, and I just saw a question, I haven't read it completely out of the corner of my eye. I saw this come in, but I think I know where it's headed. So Zach says, if you didn't already own 100 shares of AVGO and you didn't want to spend 36 grand plus, would buying a far out call substitute for the 100 shares? Okay, so what you're referring to, it's a different strategy. That would be using a long call option in place of stock ownership. That would be actually a diagonal spread. Great question. Little too far off track for me to really dig into it with you. It would just, unfortunately, not leave us with enough time to talk about the topic at hand. But some traders do that. Now, if you have an interest in a strategy that we don't happen to be discussing in one of our webcasts at that moment, that's okay. We've probably covered it already. Let me show you what you can do in that instance. So if you are new to our webcasts, make sure that you've subscribed to our Trader Talks channel. You can go down and click on the subscribe button right now. It doesn't cost anything. It literally only takes a second to do that. But our YouTube channel is called Trader Talks Schwab Coaching Webcasts. And this is where you can join our live streams on a regular basis, or you can also find playlists of previous webcasts. So for example, you asked about diagonals. I actually teach a regular webcast series. It's called Long Verticals and Diagonals. So if I click on that playlist link, I can go down through our list of playlists, and I'm going to look for it. It's going to be a little bit down below the midpoint of of all of these webcast series. Let me see. Sometimes it gets shuffled around a little bit. Let's look for it. There it is. Long Verticals and Diagonals. Yep, you can find that right there. Or as a little shortcut, you can also just do a search right here, diagonals. Let me just type in diagonal spread or diagonals. You'll find all kinds of webcasts covering that topic. What do you know? Long diagonals using long-term equity anticipation securities or LEAPs. That should be helpful. Anyway, back to our discussion here. So what we're doing here, we own 100 shares of stock. And we just sold this 21st of November 390 call. So for those in the audience that are brand new to covered calls, let's talk about what in the world we just did to ourselves. So here's what literally just transpired, obviously just on paper, but we were just paid $6.10 per share. On 100 shares, that's $610 that just went into this simulated account. But in exchange, we've made a contractual promise. Here are the details of that promise. Through the 21st of November, or for the next 18 days, that's what this number 18 means, someone has the right to buy our shares from us for how much? For $390 per share. Shares are only worth $363 right now. There's very little motivation for them to actually buy those shares right now, but at any time in the next 18 days, particularly if the stock spikes up, let's say it goes up to $400 in the next 18 days, or it goes to 410 or it goes to 420. Someone else has the right, as long as we're in this contract, to buy these shares from us for $390 per share. Now, if the gears are turning at this point, you're probably thinking, okay, so wait a second. I get what we have to gain from this. We just got paid $610. That goes into the account. Can the other trader ever take that $610 back? Nope, they can't. That's paid to us. We can decide what to do with it from here. But for the next 18 days through the 21st of November, entirely at someone else's discretion, they have the right to buy our shares for $390. So if we want to look at that on a chart, and we look at this line that I've drawn in here, let me draw in a second line. I'm going to draw in a second line on November 19th. That's this day. That's just a visual reference point to show us someone has the right to pay us this amount of money at any time up through that day. Okay, so Charmy says, and if the share price is $319 by the 18 days, good. Let's explore all the potential scenarios here. If we just put this trade on, we're now in a contract. Let's see how this contract might play out. What if the stock goes up? Let me give myself a little bit more space on this chart. You can actually just right click on the right margin of the chart and kind of move it up and down like this, just to get some more space. But let's say this stock has been coming down for a few days, but then the buying starts and it shoots up here. And on the 19th of November, we're up here at 400, 405, 410, whatever. Well, someone else has the right to buy shares from us for $390. Those shares are now worth 405, 410. What are they going to do? They're going to buy those shares. And, well, that just happens automatically if we allow this to get to expiration. They buy those shares, they pay us $390 for our $405, $10 shares, and we feel like, oh, that stings. It's true, it does. We just underpriced ourselves a bit. That's one of the trade-offs of covered calls. For a while, we're putting a ceiling on how much we can potentially make in the price per share going up. Anything above $390 is theoretically going into somebody else's pocket. That's the way it works. Well, if we sell the shares for $390, does that mean this is a disastrous outcome? No, in this case, we actually purchased the shares some time ago for $220. So it would actually be just realizing a very large gain. However, compared to what the shares were actually worth at that time, it is a little bit underpriced, right? Now, another thing that we need to consider is we got paid to do this in the first place. So we got paid $390 per share plus $610. So if we get, this is what we know, this is what's called being called out. The way that I think about this is that if somebody has the contract that says they can buy my shares from me, in the old days, we did this over the phone. And if we think of it this way, this is not the way exactly it worked, but just imagine getting that phone call. Hey, Cameron, I have a contract here that says I can buy your shares for $390. I'm calling you out. I want those shares. And in reply, I might say, that's okay. I got you covered. I got the shares right here. I own the shares. It's a covered position. It's a covered call, right? So that might be helpful in thinking about the naming of the strategy. But the 390 that's paid is in addition to the 610 that was already paid. So the total exit value would be $396.10. So what we'd have to do is just assess, well, did I pay less than that for the shares? If I did, it's a profitable outcome. If I paid more than that, it's not a profitable outcome. Let's see, what other questions we had that just rolled in here? Mighty Quinn says, wouldn't the buyer really want to break even at 401? Hey, that's a good question. So you might think, and I think this is what your question stems from. Let's say our shares are, let's say they're at 395. It wouldn't be quite 401. It actually be, I get what you're saying. 396 would be their technical break-even point. Let's say the shares are at 395, and the other trader has the right to buy them from us for 390. Well, they paid $6 for that. That's not even a break-even trade. Wouldn't they just walk away from that deal at that point? No, they already spent the $6. Why would they walk away from $5 of value, just sort of kind of throwing a fit that they'd lost $6 already? Here's where they might retrieve $5 of value. They don't break even, but they came close. Walking away leaves them $6 underwater. So here's the bottom line. If this stock is 1 penny above 390, and we allow this to get to expiration, that November 19th date, these shares are going to get called out. They're going to be sold for 390 with very rare exceptions. I will say there are just very rare exceptions where a trader decides, I don't even want the shares, even if we're worth more than 390. Doesn't happen very often. Better to just plan on the shares being sold at 390. So I got to ask you, is it a negative outcome to sell the shares above what we paid for them? It's kind of like a forced profit-taking event. Jim just asked an excellent question. Can the covered call be exercised by the owner? We would say assigned from our perspective. Can the contracts be assigned before expiration? And the answer is absolutely it can. Yeah. Now, is it likely to if we're below 390? Not particularly, but it still can be. Some trader, it doesn't matter. If it's down at 363, somebody might just get a wild hair and say, hey, my contract says I can buy the shares for 390, and by gum, I'm going to buy those shares for 390. Okay, twist my arm, buy my shares that are only worth $363 for $390. Fine, take the shares. That might be the share owner's perspective. All right, you want to buy this, pay more for the shares than they're worth? They can if they want to. They just don't do that terribly often. Now, to sort of flip that question around, let's say that our stock rockets up here early. So it's not even November 19th, and the stock's up here 395, 400, 410. Could that be assigned at that point? Yes. Even in that scenario, though, the trader the person who owns the right to buy our shares from us, they're quite likely to just say, well, it's going well. I'm just going to wait. Let's see if the stock can go even higher. I'm not going to buy it from Cameron yet. We'll see if the shares can continue to climb. Okay, Kim says, if you sell a call that has a date next year, when are the proceeds from selling the call taxable? Good question, Kim. Unfortunately, I cannot discuss tax implications of trading. I'm not a tax preparer. So it's a legitimate question. I'm always tempted to provide the answer because I know the answer, but I have to say, you need to talk with your licensed tax professional about the tax implications of your trading. Okay. All right. Anyway, so we know that if the stock goes up and we hit expiration, if it's above 390, it's getting assigned with very rare exceptions. What if it goes up, but it's just below 390? It's at 380. Somebody asked, what if it's at 389? Well, if it's anywhere below 390, the short answer is it's probably not getting assigned. It could be, probably not. In that case, we still own the shares. We keep the $6.10, and maybe the trader just sells another covered call for the next expiration cycle. Or maybe they just keep the shares and let them run up. Whatever they want to do, they're just shareholders at that point. Let's see. Can the seller of the call close the trade before it hits the strike price? An excellent question, Patricia. And the answer is yes, asterisk. I emphasized at the outset of this discussion that liquidity is a big concern for traders. And if we're trading a stock, Broadcom happens to be one of the biggest companies in the world. It gets lots and lots of trading volume on its options typically. And so if we're a small fish in a big pond of lots of trading activity and we want to buy out of this contract that we've gotten ourselves into, there's probably someone on the other end that will buy that contract from us. That's the way this will work. Let me show that in action, okay? So we know now, because we've already done it, we are literally in this fake contract where we own 100 shares of fake shares of AVGO, and we have a contract with somebody else where they have the right to buy our shares from us for $390 through the 21st of November. Doesn't that mean we have to sit here on the hook until the 21st of November? Not really, no. If the seller of the call decides, you know what, I don't want to do this anymore for whatever reason. Maybe it's getting too close to going above 390 and it's making them nervous. Maybe they really want to hold on to those shares. They want to reduce the risk of assignment as much as possible. That's one thing that might motivate them to close this contract out. Another is, well, maybe it's going way down below 390 and this contract is just becoming less and less valuable. They might be able to buy out of the contract relatively inexpensively. When a stock price falls, and as time goes by, calls tend to get cheaper and cheaper. So this 610 that we were paid, we might be able to buy out of it for a fraction of that amount. But in any case, let's go close out that trade. I was just doing it as an example anyway. Let's go to our monitor tab on Thinkorswim. This is where you go to monitor the progress of existing positions. And what you'll notice as we look, it's actually going to be down here, I would bet. Yep, let's go down here there's our short call. Sold that call, that 390 call. Our stock is right up here. It's okay, I just sort of put it in a different place in Thinkorswim. Stock's up, it's still in the same account. Anyway, to close out that call, whatever our motivation, I could just come to the monitor tab, right-click on that call, and create a closing order. So this is going to be buying back the call. Now you'll notice, wait a minute, it looks like the price is a little bit more than the 610 that we were paid. Yep, that can happen. If stock prices go up, the value of calls go up, and it can be more expensive to get out of this deal than the amount that we were paid to get into it. Yep. But yeah, to close this out, I would just select that. That brings up a trade here, and this is to buy back that one contract, 21st November 2025, 390 call. And let's say I'm putting in an order to, maybe I can get out for 610. More likely right now, I'm gonna have to pay a little bit more. It's just the way the markets have gone since we started this discussion. But in any case, I think you can put yourselves in the shoes of the trader here. Maybe not usually the case that it's right away. Maybe that's further down the line. They're trying to buy the call back inexpensively, or maybe they're just trying to close out the trade so they don't get called out, but they just come in and put in a buy order to get out of something they sold into to get into it. In any case, let's buy this 620 call. Limit of, let's keep the limit at 620. Limit just means I don't want to pay more than 620 in this case. I want to pay that much or less. Let's click confirm and send. Looking to buy this call back for 620. There's another commission to be paid here. Let me send this off and let's see if we can close this out. All right. Kevin's saying, can you look at the Delta or other Greeks to make a decision to cover call? I saw some other questions about Delta. Yeah. JF Hughes says, how should Delta play into a choice of strike price? I think I have some time here. I can do that a little bit of justice. So we're now into and out of that trade. I did want to talk about things like expiration and strike selection. Okay. So when we first started talking about this deal, now that we understand what a covered call is, we can start to try to refine the trader's decision process in getting into or out of that covered call. So when we're getting into it, when might the trader choose to do it? Well, they might do it at times when they think the stock is going to be less productive, when it's maybe coming down from price ceilings. Now, that's not a guarantee that it doesn't just turn right around and go right back up, but that's a typical technical motivation. Other traders might just do them constantly, and they're totally okay with getting assigned. Maybe if someone buys their shares from them, okay, they use the proceeds, they go buy some new shares on a different stock, sell another covered call. But what time frame of contract might we get into? In that case, I think pretty much any seller of contracts would be thrilled if they could collect a huge fat premium for a contract that expires 30 seconds from now. But unfortunately, fact of the matter is that short-term contracts don't carry much of what we call a premium. That's the $6.10 that we were paid. So maybe we need to go out longer term. Well, if we go truly long term, we could sell a call out here that gives someone else the right to buy our shares for $390 for the next 2.5 years. In other words, we're sitting there for 2.5 years with a cap on growth. That doesn't sound terribly attractive to a lot of traders either. So they're trying to strike a balance. What's enough time to make it worth my while to sell the premium, but not so much time that I'm sitting there twiddling my thumbs waiting for this contract to end? And for some traders, they find that to be somewhere between maybe a week to a month, something in that range. But differences can certainly vary there. Shorter term contracts, smaller premiums. Longer term contracts, bigger premiums, but we're on the hook for longer. Yeah, I think the question just came, how do you decide the period of a call, for example, the pros of weekly? Yeah, there you go. Exactly what I was just discussing. All right, so we use as an example these contracts that were just 18 days. Could have gone out to December. In December, if I look at that same strike price, instead of getting $6, getting $18. But I'm also on the hook for much longer. Plus, I believe there's an earnings announcement in between now and December. So we cap our growth potential during earnings season. All right. What about strike selection? Let's go back to, let's say that we stay with the 21st of November. And we're trying to choose, well, which price do we agree to potentially sell our shares for? Well, it might come from the chart. Like if we see a ceiling at 390, maybe we sell at or above 390 where we don't think the stock is going. For other traders, though, they do use delta. Delta starts with D, so does dollar. Delta, for some traders, they use it to gauge how much they might make or lose on a $1 move on the stock. Now, for others, though, they look at delta as the likelihood of assignment. So if we look at our 390, you'll notice it has a delta of 27. That can literally translate to a mathematical estimate. There's about a 27% chance that our stock will be above 390 at expiration. If it's above 390 at expiration, the shares are sold with rare exceptions. So for some traders, that can be an insightful guide. If their preference is to have a low probability of being assigned at expiration, maybe they look for a smaller delta. Smaller delta, though, is going to be associated with smaller premiums. Just the way it goes. If there's potentially less incentive for the buyer of our call contract to buy those shares, they're going to pay us, or to buy the contract, they're going to pay less. Now, for others, they might be okay with going with a higher delta because the premiums are fatter. So there are pros and cons. So I know what you'd like me to say is, oh yes, every time the trader should sell this delta. Nope, it's not that straightforward. There are pros and cons to the different deltas. Let's see, who else had a question here? I don't think, okay, I'd like to know how to handle future covered calls if the stock opens down 10 to 20% on a news event or analysts gang up on the stock. What do you do? All right, so that's a good and I think final question. I have to observe we have time constraints in these webcasts, but Fact of the matter is we own the shares of stock here. We've entered into a contract to maybe sell those shares to somebody else. What if the stock collapses in value? Who's absorbing most of the sting of that? Yeah. If we've collected $6, which we did in this example, but then our stock loses $20 of value while we're getting $6 worth of potential income, that's kind of a losing game. So what some traders do is if their stock starts to behave in a way that where they just wouldn't own, they'd prefer not to own the shares in the first place, rather than waiting through the whole contract period, they might just buy out of the contract for whatever it costs at that moment, probably less than what they were paid because the stock is going down, and then sell the shares. So it could be because an analyst is picking on it, could be because there's an earnings that went south. It could just be because some other news announcement came out, or maybe just a price level broke on the chart, and there's some additional selling as a result. But in any case, yep, maybe they just buy the contract back through the process that I just displayed and then sell the shares. So let me just double check. I always make some notes here. I want to cover everything. I think we've addressed what I wanted to discuss. We know that if the stock goes up, we have a cap on how much we can make. In this case, 390 or above goes to someone else, plus that income that we've received. So most that we can theoretically make here is whatever the current price is, up to 396 and 10 cents. If the stock falls, if it loses more than $6.10 in value, the covered call is taking some of the sting out of that loss, but it's not completely erasing it. And I think we've addressed everything else that I wanted to cover. So guys, this has been just an introduction, just a beginner's guide to selling covered calls for income. This is what we do in these Monday webcasts. We talk about either covered calls or selling put for income every Monday. Talk about the pros and cons. I will say typically we go through through current positions from previous webcasts. I chose not to do that today because I saw how many new people there were here, and I thought that might just add sort of a additional element of confusion or a complication. So I set that aside. So for those that watch this each week, we'll get back to the existing trades next week. So if you want to join me next week, you're certainly invited. But guys, time for me to let you go. I hope you've enjoyed this discussion. I really enjoy these Monday webcasts. As you go, though, I have a few suggestions for you. All right. Schwab offers a huge range of educational offerings, all for free. I want to make you aware of what they all are. So first of all, if you are new, and if you haven't subscribed to our Trader Talks channel on YouTube yet, do that right now. Go down and click on the subscribe button. It only takes a second. It doesn't cost anything. But this Trader Talks Schwab Coaching webcast channel is where we house our playlists of previous webcasts. Almost all of our webcasts make it on the playlist. You can join our live streams, or you can even do searches for topics of specific interest. Now, a couple of other things you should be aware of. Barb's been helping out in the chats. Thanks for helping out there, Barb. But you can follow Barb and me and your other favorite Schwab presenters on X. Let me show you. So here's my profile on X. My handle is at Cameron May CS. You can find Barb here at Barb Armstrong CS. But if you follow us on X, this is where we can post, market updates, interesting developments, even just what we did over our weekend. It's a great place to connect with your favorite presenters in between the live streams when the camera's off. So if you reply to one of my posts here, I try to reply right back to you, and allows for that sort of interaction. You can also follow me, though, on LinkedIn. This is pretty new. I have 17,000 followers on X. I only have like 100 people following me on LinkedIn. So if you have a LinkedIn profile and you want to connect with me there, let me show that to you. So there I am sitting on a bench in front of this castle. That's my profile. But I'll post videos and market commentary, that sort of thing here. And if you reply to my posts here, I'll reply to you here as well. So follow me on LinkedIn. Just look for Cameron May. Barb, thanks for helping out. Chat. Everybody, I'm going to make one other recommendation for you as I let you go. If you are new to options trading, I have a whole series that I've recorded, and I continue to deliver. It's called Getting Started with Options. Let me post a link to that YouTube series here in the chat window. There you go. But you can just click on that link. It'll take you right to my playlist on YouTube for my Getting Started with Options. I even put a series of lessons together, lesson 1, lesson 2, lesson 3, lesson 4, to bring you along if you are brand new to this world. For everybody, thanks for giving me your time today. Barb, thanks for helping out in chats. I will look for you all in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.